Hi traders, it's Bruce Banks here, and today we're going to go over candlestick charts versus open, high, low, close charts, or bar charts. Now, first I want to say the information that these two charting styles represents is identical. It's just delivered to you in a slightly different manner. And the choice is yours, but I'm going to give you a few in-depth look on exactly why people choose often candlesticks over bar charts. Now, first on the left here we have a candlestick chart. Each bar represents the high and the low, the open and the close. Now if we zoom in here, we'll look at this green bar here. So the high it made, right now we are on a 15-minute chart, the high that it made is represented by the peak of the wick. And the wick is this bar area right here. And this very narrow, well, that's why they call them candlesticks, wick. And so that tells you that within this 15-minute period, the market made it up to here, and the lower wick here, the market made it down to here. And this solid area is the difference between the open, where you can look at the previous bar where it closed, and the open will be at the bottom here, and then the final close at the end of the 15 minutes is right here. And then the next bar opens at this previous bar's close. You can tell if it was a positive or negative close, like if the market opened higher than it closed or it closed higher than it opened, by the color of the candlestick. All the colors here are customizable as well. You'll see people with black and white and even blue and red. It's a personal choice here. So you can see a candlestick is a negative, or its open was higher than its close, by the red bar here. So we look at this red bar and we can see that the open here was higher than its close. So that means that this would be a red candlestick. But within that 15 minutes, the market did push its way up here and push its way all back down here. But within the 15 minutes, by the time that ended, it decided to close right here and open the next bar. Now, this is the same for bar charts or open, high, low, close. Bring this up, and we'll actually look at the exact same bar here, which was this one. So instead of the candlestick's wick to give you a clearer representation of exactly where the market traded but didn't actually open or close in, it just fills it with a solid bar, and these in-out points are how you can tell where the market opened and where it closed in that particular bar. So looking at this green bar right here, its open is on the left-hand side, so it opened here, and within its 15-minute period, it made it all the way up to here, same as the candlestick, and all the way down to here, same as the candlestick. And its close was right here. Now the only difference really is the fact that on the candlestick charts, the parts where the market traded but it wasn't part of its open or close are represented by these thin lines. Now you might be asking yourself, why does it really matter? All of the information is incredibly relevant. Now the only difference is the fact that some traders don't consider where the market possibly traded but didn't end up opening or closing as important. It's all important. You want that information on your charts. That's why we choose candlesticks and bar charts. We don't want to hide any of that information. But with the bar charts, it doesn't actually weigh it, but visually it almost weighs wherever the market traded in that 15-minute period in all of these bars as visually quite similar. Whereas candlesticks represent that information a little bit clearer. And one of the key times that traders will pay attention to this is during the daily charts, and we'll pull those up right now. Now you can see we have the same time period pulled up on both the daily candlesticks and daily bar charts, and the bar charts end up being a little bit more messy, and it's hard to see exactly what happened during certain periods. We'll highlight this area right here. on both the daily charts for the candlesticks and the daily charts for the bar charts right here. And it looks a lot messier, I find, on the bar charts than the candlesticks, because we look over at the candlestick side on the left, we can see that the market was actually quite flat in its open and close during this period. The market did push up with quite long wicks, but it didn't end up managing to close there. Now we'll zoom this out even a bit further and see if we can't get a good representation. Now, one thing that traders look at, especially in the daily time frames, is exactly where the market opened and or closed. Not so much if the market was able to be pushed down in that actual intraday period, especially when you're drawing trend lines. We're going to draw a trend line on both these charts. Now, if you draw from the absolute bottoms that the market made, as low as the market pushed down intraday, it gives you one particular trend line. Whereas a lot of traders put a lot more weight, and I particularly do, on the actual close of the market. Like, how far was the market able to be pushed down, but then actually able to close at that level? So when I'm going to draw a trend line, I'm not going to pay as much attention to how far the market was pushed down. I'm going to pay attention to the meat of the trade, and that's basically where the market was actually able to close at. And when I draw my trend line, I'm not looking at these wicks on the candlesticks. I'm looking at exactly where the market closed. And that gives you a bit of an interesting representation on this example. If we drew the trend line on the left-hand side with the candlesticks, just where the market ended up pushing its way down to, we had a trend line with two points and no others, and it's still a good trend line. It's quite similar to the trend line, the next trend line that we drew. But if we look at the trend line where we're specifically looking at where the market closed, and that's where we're drawing our trend line, we see we actually get a trend line that touches at 3 points. Now the market pushed down a bit past this. You can't use this trend line. It's not a guaranteed. This trend line isn't a representation of exactly where the market is going to bounce off of. It's a representation of the expectations of the traders on the upward or downward momentum in the market. So if we look over and we try and draw these exact same trend lines on the bar chart, it's not saying that we can't do it, but it's a lot harder to identify exactly where the opens and closes are on a brief overview of the market and a brief quick look. And if you're trading more than one market, you really want to make your trading experience as streamlined and as fast as possible. So we can draw these exact same trend lines, but to actually pick the specific points in the market where the market opened and closed, it requires a little bit more time and effort to identify them. Now, this is all because, like I said in the beginning of the video, the information that these two chart styles represents is identical. Opens, highs, lows, and closes. It's just that candlesticks, and this is one of the reasons why they're more popular, represent that data in a slightly cleaner manner. I hope this clarified up the difference between bar charts and candlestick charts, and I look forward to seeing you in the next video.